Good afternoon, everybody, and welcome back to the Fintech Nexus weekly news show. My name is Peter Renton, Chairman and co-founder of Fintech Nexus, joined as always by my good friend and colleague, Todd Anderson. How are you doing, Todd?
I'm well, Peter. How are you?
Doing great. Our special guest today, the inimitable Ron Shevlin. How are you doing, Ron?
Doing great. Good to see you guys again.
Yeah, good to
You
see
as well.
you. We have now gone 2 weeks with no bank failures. We are on a roll here in this country. And we've also, not only that, we have had the bank failure that sort of was the biggest of them all, and at least in the last decade. Silicon Valley Bank has found a new home, shall we say. First Citizens, which is the 30th largest bank in the country, has acquired the 16th largest bank, or at least parts of it. It's acquired the deposit base, 56.5 billion. I wonder if that number is still the same now that your government insurance doesn't go up to infinity, and for the now that it's taken off the government's hands. They also had $72 billion of loans that they got at a significant discount. So the FDIC is going to share in the losses or the gains of this purchase loan portfolio. And so anyway, now, I mean, this is like half the bank, it feels like, has been put to rest or put to a new use. What do you guys think?
Todd, go ahead first.
Well, I think the first is that the fact that it wasn't acquired by the bigger banks, I think, is a good thing. That someone a bit smaller, no, that not that much smaller, but that it wasn't just absorbed by the top four. Though a lot of the deposits of the last couple of weeks have been absorbed by the top four, which is not necessarily good news. Um, I think it's probably a smart move by First Citizens. They got a discount on some of the loans. And I'd be curious, and this is a question that I think we've asked and talked about the last few weeks, which is, Silicon Valley Bank filled a specific role in the market for founders. And I don't know if just First Citizens can just fill that role like they did. So I still think there's going to be pain for founders, and the exact role that First Citizen will play, I think, is still to be determined. Good move by them, but I still think there's a lot of unknowns for founders and those that are venture backed.
Yeah, Todd, I think you're spot on that. I think it was a good move for First Citizens, and I think it's important for people to recognize that this is not the first time First Citizens has picked up a failed or a struggling institution. So suggests to me that they got a process, they got people who know how to kind of do this. But it really kind of begs the question: are they doing it because they think that they can do some financial jujitsu on this and make it good, or are they looking to do it because they want to get into the tech space and be a bigger name? And if that's the case, then they're going to get a lot of competition. There's going to be a lot of fighting for that, and I can't help but wonder how much of the business they'll really be able to retain when people start really competing for that business.
Yeah, because they haven't been known as really a tech-forward bank, or really a bank for the tech sector, shall we say, like Silicon Valley Bank has been. Maybe they want to be known as that, but certainly that hasn't been the case. And the tech sector, which was just almost exclusively with Silicon Valley Bank, we don't know. I imagine this is going to be split up now amongst others. Certainly, they've got a bunch of deposits. We'll see how long those deposits stick around, I guess. So moving on, I want to talk about the new wallet. We have a new wallet, and the wallet wars are underway in earnest, shall we say. Early Warning Systems, which is the maker of Zelle, which has been a very popular peer-to-peer payments product. They are now, they've announced the new name of the wallet that they are going to be launching, Paze, Paze. Not a big fan of the name personally. It sounds like some sort of medical condition to me. But anyway, they are going to be doing a pilot in June with 7 of the largest banks. The thing that's interesting about this, that when you go and start using Apple Wallet, you have to go and upload all your credit cards and debit cards and what have you. Here, the big advantage they have, because these are going to be banks that actually have these cards themselves. Like, so all of your Chase, all of your Citi, Capital One, I imagine, they're going to go in automatically. They're going to roll out with 150 million Visa and MasterCard holders when they come out, then they roll out this fall. So that's going to sort of make them a little less friction involved in getting underway. But boy, they got an uphill battle with Apple Pay and Google Pay, very, very well entrenched in the wallets of millions, tens of millions of people around this country.
I still don't know what the incentive is for me to go to Pays versus staying with Apple Wallet. It's, and especially if you're an iPhone user, you kind of, you tend to lean towards Apple related things to begin with. And I mean, that's why we'll talk about it later. The Apple Pay later, I think, is a good move by Apple. But the biggest thing I wonder is just how do they get people to use Pays versus Apple Pay,
Right.
or whatever you're entrenched in already. It's not easy to say, all right, we'll just use this. Now, will some people? Yeah, sure. And the big banks, I don't want to sit here and say the big banks are idiots, so they clearly have a strategy behind this. But I still think it's a big climb to get people out of that entrenched user experience that they're already used to with Apple Pay.
Yeah, I would just throw in there, kind of remind you guys that Apple Pay, even among Apple iPhone users, is not ubiquitous.
Right.
And just like Venmo was not ubiquitous when Zelle came in, and Zelle has, at least from a dollar volume perspective, I think far exceeded Venmo.
Yep.
And predominantly because of the demographics of the user base. They captured old people. I don't know if everybody's got their cameras on for this one, but I'm not talking about you guys either. So, there's plenty of room for growth. But you do raise a great point, Todd, about the sort of the incentives and the user experience. When this story first broke, I think on the Wall Street Journal, they had a scenario for how this was going to work with, emails being sent to enroll. And I was like, that's it, you're out. It's like, if this is not super simple. So it sounds like they've kind of taken care of this a little bit with automatic enrollment, but still begs some questions around, how do you really drive utilization of this new wallet in the face of, Google Pay, Apple Pay, PayPal, and see what the benefits are really going to be. So, but I wouldn't count them out. They had to do this. This was, if they didn't have a digital wallet strategy, the big banks, that is, they would have been really hurting in the next couple of years.
Yeah, the thing is, when you're going to have you have to download an app. You have to download the Pays app, which obviously when you've downloaded and authenticated, it sounds like you're going to get things. Your cards will come in automatically. But to Todd's point, I'm just like, maybe they'll just slowly build this up. But what's the incentive? Apple Wallet comes with the phone. You don't have to download the app; it's right there. And
one incentive
Yeah,
I was gonna say one incentive. I wonder if, and I don't know how they figure this out, but eventually we're gonna have our licenses in the phone.
Right.
And I wonder if there's some way that they strike a deal that's where some of the incentive is, that they can get the license in the Pays app or some partnership there. Because to me, I still think digital wallet adoption has a cap on it until your license goes in there. And then because right now, most places, I think, except 3 states, you can't put your license in your phone. And so there's still a bit of a limitation because you have to walk around with something in your pocket. And some people are like, I might as well have my cards in there too, even if they're starting to use digital wallets. I do think that could be one incentive. If they strike a deal, that could maybe tip the balance.
I'm going to bet against that deal, Todd, at both the federal and state level. At the federal level, you just there's no way Elizabeth Warren's going to do anything to let the big banks get anything. And at the state level, you're going to have just a bunch of community banks and credit unions raising hell for letting the states make a deal like that with any of the major banks. So But you're right on that the identity piece is important. I'm kind of surprised you'd have to download the app. At least with Zelle, they had it built into the, the bank's mobile banking
Right.
apps.
Right.
So you eliminated that. But yeah, we'll see where it goes. But I think I'm kind of with you guys that I'm not super optimistic that this is gonna be an immediate success.
No, I mean, it might, it's like 5 years is a long time. But one thing I just wanted to add before we move on, I interviewed Max Levchin, the CEO of Affirm, on my podcast a couple of weeks ago, and he said, well, it was really surprising to me. He thinks the card form factor still has a lot of legs. He even said that in 20 years' time, people will still be using physical credit cards because it is so easy to use and it's got such utility. And so that is obviously going to, lessen adoption of all these digital wallets. But anyway, we've got to move on because we want to talk about Apple Pay Later, to be precise. Launched this week, launched with the standard sort of pay in 4 offering over 6 weeks that Afterpay popularized. And they're working with MasterCard and Goldman Sachs. Ron, you had a great article on this yesterday in your Forbes column. Why don't you sort of take us through your thoughts on this?
I am very bullish on this, and maybe not in the immediate short term, but for the longer term, I think this is a huge opportunity for Apple to kind of jumpstart not only Apple Pay but Apple Card. I think getting into the buy now, pay later space is a way to kind of offer small credit to individuals who need it, get them into the use of the credit, and then get them into the Apple Card. Which has kind of struggled a little bit. Good, initial takeoff, but definitely has not been super successful in the past 2 years or so. But it's also the opportunity that they'll need to do is kind of build out more merchant e-commerce enablement stuff. I wouldn't rule out Affirm and Klarna just yet. I love what Klarna is doing with their search engine, with the creator platform, with a number of other things. The buy now pay later space is getting really, really competitive, and it's good to see Apple kind of get in there. And I think it's ultimately, over the next couple of years, going to be very successful for them as it drives business to the Apple Pay and Apple Card.
Yeah, I'm with you. I'm a big fan of Apple. I use Apple products left and right. I have an Apple Card. I did the Apple buy now pay later product, and it's the thing with Apple is, I can't remember a bad experience with them in recent years. It's just very, very simple and easy and smooth, no matter what you do, and it just feels like they have the sense of what the customer wants. And while they have struggled in different areas of Apple Pay and not wide adoption just yet, I do think they're gonna that simpleness of their products just has them set up for a lot of success here.
Yep. Yeah. And the reality is consumers like buy now, pay later. They have clearly, this is something that, is not going to go away anytime soon. It's only going to get more and more popular. I mean, I know the CFPB is looking at some of these platforms, but the reality is the consumers like it. They like to have different options. So I think you'll be seeing, it's not like a winner take all zero sum game. You're going to have your Klarna, you're going to have your Affirm, you're going to have your Afterpay, and you could have your Apple, and you could use all of them potentially. Hopefully, not going into too much debt, but there is that there's room for lots of players here, I think. Anyway, moving on. Wall Street Journal had an interesting piece with a stunning graphic that I was really amazed at. Talking about the top 25 banks and all the other banks, right? So you got the top 25 banks. After the Silicon Valley collapse, gained $120 billion in deposits. Everyone beyond the top 25 lost $108 billion in deposits, and $220 billion flowed into money market funds. So you've got it's just this bifurcation that we're seeing. And I just worry. I mean, I feel like if you're a mid-sized regional bank or a small community bank, you've probably had outflows. And that's not a good thing for the almost 5,000 banks that are out there. If you're not part of the top, you're potentially losing. And I feel like this is also going to drag into lending. We've got a lot of the smaller community banks. They do a lot of small business lending, a lot of commercial lending, and that could be impacted. So it's who knows where this shakes out, but really it's not been a good month for community banks, that's for sure.
Ron, you want to take that one first?
Sure. So this may go down in history as bad a call as your SVB is doing fine call from a couple of weeks ago.
Right.
But I actually think long term, and I don't even mean long term, I mean a couple of months at most, this is not going to be a problem. And I'll tell you why. Okay. First of all, I think a lot of that money that has moved to the big banks is hot money. And I think it's important to recognize that I don't believe that it represents, from a small to medium-sized businesses perspective, does not mean that they closed out their accounts with the banks they were doing business with. I think it represents that they moved the excess money, the uninsured, to other places in fear of that. I think the reality is that the overwhelmingly vast majority of small to mid-sized banks are doing fine, will continue to do fine, have very good risk models, and that money is going to come back to them. And I also think that a lot of small business owners, small to medium-sized business owners, are going to find that the service and the product from a small business perspective at the big banks suck. They're not getting what they need to get with what they were getting from their local banks, and I don't think the big banks are going to be any more willing to lend to them than their existing banks are. Mm-hmm. So I think that money is just hot money that's moved for now. I think they're going to see the flows turn right back around over the next couple months. And man, you guys will, I'm sure, get me back in a couple of months ago. Ron, you said this, and look at the numbers in the Wall Street Journal today, but I'm going to put my stake in the ground and say I think the mid-sized banks are coming back.
Okay.
I think as long as there's not, another bunch of bank failures, I think over time they will bring their money back, especially on that last point you made. I mean, there's a reason why some of these banks, even Silicon Valley Bank and like Signature Bank, served niche markets because they can't get served elsewhere. And in local communities, they are a lifeline to a variety of different businesses that the big banks, don't know at all and won't lend to because they don't even want to take the time to. And if they move some money out, they're not going to go away for that long because they'll realize, oh, crap, the service, I remembered why I went to the small bank in the first place, because the service at Chase or whatever is going to ignore me, or they're just not going to serve me the way Joe does at the local bank that I've known for 20 years and has always taken me in, in good times and bad. So I also think these days we tend to look at things that happen and think it's the end of the world or it's the greatest thing in the world. And we're at it's only been a few weeks.
Right.
And I do think over the course of a few months or a year, if we look at that chart again, how different might it look? I don't know. But as long as we don't have another batch of bank failures that inject more chaos into the system. And maybe that's why Jamie Dimon was hell-bent on saving First Republic. He had a sense of, as long as we don't let more bank failures, we can kind of steady things out, even though and if they get more hot money for JP Morgan, great. But I do think he knows that overall the banking system needs to be more stable and that more bank failures are bad.
But the one thing that I don't think enough people are talking about is we have to move on, but just one more point that, we're a small business at Fintech Nexus, and we are now going to do treasury management. We never did treasury management. We just left money in the bank account. But we'd actually started talking about this before the Silicon Valley Bank collapse, because suddenly you can get 4% on your money, which means you don't really want to leave it in your checking account. But still, I just wonder how many small businesses are going to be okay with leaving above the FDIC limit in their bank account. And that, I think, is an unknown factor. And if we don't change the limit between business and consumer, I think that there could be some changes there.
Quickly, Peter, if I could
Yep.
just interject one thing, I'll take more than 30 seconds on this, I promise. It all depends on whether or not what they really should be looking at is not necessarily doing treasury management, but just asking their banks, do you participate in the intrafi networks, whether
Right.
it's CDARS or ICS? I mean, why isn't every bank doing that,
Yeah,
or
every bank.
some version of
Yeah.
that?
Yeah, indeed. Anyway,
Yep.
before we move on, I'm going to do a quick shout out to our friend Tim Lee. He was talking about the Apple Pay Later thing, talking about the potential that Apple has, the leverage that they have over you if you're not paying your Apple Pay Later card. I don't know if that's actually going to happen, but I thought it was an interesting comment anyway. So moving on, talking about still on the banking system, because this was another piece in Bloomberg talking about the FDIC needs, it has its deposit insurance fund. It's taken a hit on that $23 billion hit, according to Bloomberg. So that needs to be replenished. And that's the question is now is who is going to pay for it? There's going to be a formula proposed in May. And I didn't realize this, but in the last financial crisis, where there was also a hit to the deposit insurance fund, and the big banks had to pony up. JP Morgan, I think it was $675 million hit after they had to pony up extra for the FDIC insurance fund. It's going to be more than that probably this time. What do you think, Ron?
Well, I think you two and me represent three of the many people who will actually end up paying for this.
Right.
Let's get real here. But politically, this was a real smart move to basically backtrack on Janet Yellen's comments from about a week ago, where she basically, pulled the plug out from small and mid-sized banks, and where it looked like it was the unaffected small to mid-sized banks who are not only seeing the hit from this from a deposit perspective, but then were expected to pay up for this. So this is I think mostly a political move, but it's just going to be tough because those costs will always trickle down to the customers.
Yeah. No matter how many times they tell us it's we'll take on the cost. I mean, interest rates on loans, less interest if you put your money in the bank that you're going to get. I mean, we'll eventually feel the hurt of it in some way, shape, or form.
Yep. Anyway, the last story on the SVB thing, and then we're going to move on to crypto. The impact on VCs. Our own Isabel Castro wrote this really interesting piece, interviewed a bunch of VCs, talking about the impact on them just to a week or two after the crisis, and they, VCs are now talking about we need to know what our portfolio companies are doing when it comes to banking strategies and treasury managers, and that's now going to be a new requirement that everyone trying to raise money has to disclose what they're doing there. And the fact that fintechs, they're now everyone's moving cash into multiple banks. I saw there was one of the there was an offering from someone, the $75 million FDIC insurance up to, so by splitting it across 300 banks. But everyone needs multiple bank accounts today. That's the other big thing. And they're talking about the other big question that everyone's wondering in the VC community is who is going to acquire the $9.5 billion portfolio that Silicon Valley Bank Ventures or Capital, I think it was SVB Capital, I think is the name of the organization, the venture capital arm of the bank, which was a very active player in technology equity investment.
Yeah, that's going to be an interesting one, is who eventually gets that. I mean, I don't know how many VC firms can just swoop in there. There's probably not many that can acquire it, and I don't know if they can somehow split it up in terms of what what VCs might acquire what portion of that portfolio. But I think it's interesting that VCs are now on top of the treasury management and what fintech should do or should put their money in. It's I don't know how long that'll last, because I think stuff like this kind of, yes, this is what we'll do, and then in good times they tend to forget some of this stuff. So I'm not sure if that's going to be a requirement long term, but I mean it's some of the after effects of what they see in the market, and a lot of VCs were personally impacted by SVB because they had money there. or they had portfolios that had money there. I don't know if the impact would have been as big if it was like some other bank that, didn't have all these tie-ups in the tech and venture-backed space. So I think it's apparent to them now. How long that'll last, I mean, I think people have short-term memories.
Yeah, good points. I don't know what your colleague found talking to some of the VCs, but I got to really believe that some of the really good VCs, they were doing this already. They were smart enough to be looking at this. I just think it kind of shows you that being a VC does not mean you're on top of all of this stuff. They were good ones, and I wouldn't call them bad ones, but yeah, it would be interesting to see. And if I wanted to, and I haven't really ever dug into this, but if you want to kind of get some insight into who might pick up the portfolio, start looking at the limited partners, and see,
Yeah, good idea.
That, to me, that would probably be the best candidates for, picking up the or parts of the portfolio at least.
Right.
I guess the one thing about this whole crisis is it's always a good thing when people learn more about how banking works.
Yeah.
And so as a byproduct of what's been going on, at least more people, and some have on Twitter have not clearly realized how banking works yet. But overall, I think more people have started to look into how some of the system works, which I think is a net positive overall.
And it's amazing to see some of the tweets that some of these venture capitalists were doing. They just didn't understand the basic tenets of banking.
Well, hold on. They did. I'm hardly the one to ever stick up for a VC. But look, they helped to fuel the bank run, but they were giving legit advice to their portfolio companies. And they didn't care about the bank; they cared about their portfolio companies.
Right. Anyway, let's move on. There was some crypto news this week. We haven't talked much about it the last few weeks. Funny that, but there was some crypto news. The CFTC is suing Binance and its founder CZ for operating an illegal exchange and for weak compliance. I didn't realize Binance is the biggest exchange, right? $23 trillion in trades last year on Binance.com. Now that's mostly out of this country, but Binance.us is operating in this country, and the CFTC. While Binance has always maintained totally separate company, totally separate everything, the CFTC argues that it's really effectively a subsidiary and controlled by CZ, and it's all like, according to the CFTC, this is one of the most damning things. It's basically encouraged its US customers to evade some of the compliance rules, and if that's true, they're in big trouble.
Yeah, I mean, I thought there was a couple of juicy tidbits that were interesting. One was which was they're pushing people to VPNs, and not that a lot of people need help with VPNs these days. They're pretty easy to figure out, but they were pushing US customers to VPNs. They were talking about fraud on various networks and closing their eyes, knowing that people were doing fraud, like the Russians, I think one of the comments was. And, that they were able to access CZ's phone and see some of these messages as well, or at least the people that were sending messages. So I think there was some juicy tidbits. Ultimately, there is a problem if you read in some of the complaint, they can't even locate exactly like where Binance's operations are or stem from these days, and the way in which they run the operation, since it's offshore and we've never embraced crypto, is continuing to throw a lot of clouded interests around the crypto space, which I don't think is good for the crypto space long term if they want to interact with the banking system. And so I don't think it's good news for crypto, but I guess we'll see.
Last comment I throw in there, because I know we're getting close to time here. Have you guys seen the administration's economic report of the president?
Yeah, we talked about that last week. Yeah,
500 pages. I think I'm up to 337. But fundamentally, it is a manifesto for anti-crypto.
Right.
And so there is a anti-crypto undercurrent here from a U.S. government perspective.
Mm-hmm. For sure. Anyway, just before we close, last thing I wanted to mention, the UK Treasury has cancelled plans for their government-backed NFT. Sad face. That is, I was actually there. I was actually in London when they made that announcement. There was so much excitement. This was at a big event in London, and it was like where UK government really gets crypto. They understand what's going on. They're doing an NFT, and now they've quietly just canceled the whole thing. But anyway, we have to close it there. Thank you, Ron. As always, really appreciate you coming on the show.
Thanks, Ron.
And for your comments.
Thanks, guys.
Thanks, Todd. Before we go, just a quick reminder, Fintech Nexus USA happening in New York City on May 10th and 11th. Go to fintechnexus.com to get your ticket now. Okay, we'll be back same time next week. Have a great afternoon, evening, and we'll catch you next time. Bye.